Hello, everybody. I'm David Darst, and it was quite some week that we just experienced in June. Last Monday, the S&P 500 rose 0.3% because China has made some preliminary moves towards easing financial and economic conditions and regulatory conditions out there. Tuesday, the market was up another 1% because the World Bank reduced their global GDP forecast for 2022 from 4.1% down to 2.9%. Why is that a good thing? It means maybe there'll be less pressure, less inflationary pressure if economic growth is slowing. So the market saw that as the glass is half full. On Wednesday, the market, Standard & Poor's, fell 1.1% based on strong GDP growth in the Eurozone. And that means the European Central Bank might be able to start tightening more aggressively. Their meeting was last week on Thursday. And in fact, so the market fell 1.1%, then it turned around and fell another 2.4% on Thursday because the European Central Bank has indicated that they plan very soon to move from quantitative easing to eliminating the quantitative easing and maybe even starting towards raising the policy interest rates, which have been so long in negative territory. Also, the weekly jobless claims in the United States came in at a multi-month high, people filing for unemployment insurance. Then Friday, the bottom fell out of the market. The Standard & Poor's fell 2.4% on Friday because of the hotter than feared consumer price index. As you may have seen or heard, on a month-to-month basis for the month of the consumer price index rose 1.0%, and it's now up on a year-over-year basis 8.6%. Core, which is after you strip out food and energy, core for the month of May, the consumer price index was up 0.6% and up 6.0% for the year. Then on Friday, as if you didn't need worse news, piling the University of Michigan Consumer Sentiment Index, which is very heavily influenced by inflationary trends, and it hit 50.2, which is an all-time record low. I think they've started this consumer sentiment indicator metric several decades ago. I'm talking about 50 years ago. It's the lowest it's ever been. The S&P 500, when you get done with all this, last week fell 5.1%. It's been down 9 of the last 10 weeks, as you've heard me talking about, and it's down 18.2% for the year. The Nasdaq Index, which is technology heavy, fell 5.6%, and it is distinctly in bear market territory, now down 27.5% for the year to date. The banks are one of the bodyguards of the market. The banks, the transportation stocks, and the Russell 2000. The banks had a particularly difficult week last week, down 7.8% and down 20.3%. So they are in bear market territory. And you had JP Morgan Chase, you had Bank of America, both down over 8% last week. Now, the 2-year Treasury closed at 3.05% on Friday, and that's up 40 basis points. And one of my colleagues just mentioned to me that it closed on Monday, believe it or not, on Monday, today, at 3.40%. The 10-year Treasury closed at 3.15, which was up 19 basis points last week. These are big moves, and it was up to 3.43, okay, which is another 28 basis points on Monday, the 13th of June. The 30-year 3.20, it actually declined. Why did it go down while the others were going up? Because people feel people will go into bonds if we get a recession coming. So you see the Fed tightening, that's causing short and intermediate term interest rates to rise at the same time as the more and more people are talking about maybe a recession occurring late this year, early next year, and that's causing people to think about buying longer-term bonds, which actually went down last week, although on Monday they went up 22 basis points to close at 3.42. Oil, $120.67, up 1.5% last week, up 60.4% for the year to date at $120.67. The dollar was up 2%. It's up 8.6%, and it is one of the 6 Feds. You got the Fed, interest rate Fed, you got the quantitative tightening Fed, you got the verbal guidance Fed. All of those are tightening, but the real tightening has gone on in the oil market, in the currency market, and in the asset price destruction market. The junk bond, and look, people are ignoring junk bonds right now, but that is very indicative of credit conditions. And the junk bond ETF symbol is JNK. It fell 3.9%, and on a year-to-date basis, including the coupon from these bonds, is down 11%. This week ahead, we've got the Survey of Consumer Expectations by the New York Fed. This is one I follow quite closely, and we will be reporting on that next week. The May Producer Price Index will be tomorrow. That's Tuesday. Expected to be up 0.8% for the month, 10.8% year to date. Wednesday's the big day this week. Wednesday, the Federal Open Market Committee meets. People have been talking about 50 basis points. Will they raise 50 basis points? Will they raise 75? And there have been a few people, Jim Cramer, Professor Siegel of Wharton, have been talking about maybe even 100 basis points. We also get the May retail sales and, very importantly, the Empire State Manufacturing Index. Thursday is the Philadelphia Fed Manufacturing Index, housing starts, and Friday is the May industrial production and the May leading economic indicators. With that, I wish everybody safety, security, stability. Take it easy, and we'll talk with you next week. Thank you very much. Bye-bye.